second last day of the month. We had a big moment yesterday. Oil popped above 80 and then did a big retreat. It would appear on the surprising data report out of the US API inventories building rather than declining, which seemed to be very countercyclical and against expectations. Let's kick off with Matt Stanley, Director of Star Fuel, sitting in Dubai. Matt, your read on this somewhat would appear volatile market still. I thought we would have held above 80. We didn't.
Well, we popped up. Morning, Sean. Thanks for joining us. Much appreciated. We popped above 80 yesterday. We hit $80.60 at one stage yesterday, and it was gloves off. I really did think that we were getting to. I don't want to quote Omar, but triple figures. It wasn't far off, but the rhetoric was so strong. The force coming into the market was so strong regarding supply issues that it wasn't out of the realms of possibility that we would get there. However, $80 is a significant number. Just mentally, it's an important number. We're back off it now. We're at 77.50 just on November. I mean, December is traded at 76.86. Structure has come off about 20 cents in the last 24 hours. So that's sizable.
Is that anything to do with last day of trading, do you think, or is it?
It's probably. I mean, there's a roll down trade that people have got. Liquidity is pretty poor. It's Wednesday of OPEC, so Sean,
right.
I appreciate your gremlins. I've had them for the last 17 years at Wednesday of OPEC.
I wish that was the excuse. I wish. Sitting in sober Dubai as compared to liquid Singapore.
Yeah. Look, Q3 this week is a very important week. Tomorrow is an important day. Non-farm payrolls.
Right.
They're going to be critical for the market. Is it tomorrow? Or is it next week? Excuse me. Whatever it is, it's a critical economic indicator for Q3.
Well, it seems to be the Fed are still obsessed with making sure every last Joe on the couch gets a job at McDonald's.
Right. Other fast food outlets are available, Sean. Popeyes.
Right. Yes. Don't want to give too much.
Yeah, exactly. No, look, 77.50 we are on Brent. I just think 80. I said this to you about 2 months ago. $70 was too rich. What was too difficult an argument to form to buy crude oil, and here we are at 80. Is that too? I've said this for the last 18 months, and I feel like I'm. Well, I'm not going to actually say what I was about to say, but.
You're not a broken record. No, you're not.
No,
you're actually bullish for a while. I mean, that was like you thought Arsenal were going to win the league. I mean, I'm sure you thought that even this week after they beat.
That team in North London, Sean. But I mean
this is
the prism of oil. Let's just move on from that. But it's $80 is for the end user is a prism that I think is too far. It is too expensive. When you can only apply the rhetoric against high prices to a supply curtailment rally. That's the issue.
Yeah, but everything is $80, isn't it? I mean, iron ore and, wood and, every potential commodity that you got to put into your daily life is popping at near record, including the natural gas needed to heat your house. Let's bring in Kevin Wright, lead analyst at APEC, not APEC, the conference, but APEC, the region, with Kepler. Kevin, you might be the one deserving of the gremlin hangover from Singapore, seeing as you sit there, but I'm not sure if APEC is delivering on that this year. But demand-wise in Asia, are we seeing the vaccination rate climb and the demand numbers grow?
Good morning, Sean. I'm actually sitting in a little town called Derby in the middle of Singapore this morning. Having moved out of Singapore largely due to restrictions, etc., and a desire.
Oh well, I did hear a data point on my commute this morning on local radio saying 4% of expats have left Singapore. Yeah, I don't know why they go to Derby, but I'm not sure they all went there.
I'm an extreme case.
Have you gone back to salvage Derby Football Club? I heard they went into liquidation recently.
That solution doesn't exist. They are not
Oh.
salvageable. No, they're
Oh
gone.
no! Oh,
No,
God.
I jest. I mean, you know,
The
the
old
situation
warhorse.
with Derby is a bit desperate,
Yeah.
but yeah, I mean, coming back to demand. I mean,
Yeah.
and looking across Asia, we were just discussing the sort of the attitude and the vaccination rates across the countries and so on. And obviously, Singapore is a good example of rhetoric not matching the actions, right? So you hear the government talking about reducing publicity, if you like, for numbers, and yet they continue to pursue this zero COVID strategy. And we're seeing that in terms of demand figures. I mean, Singapore is a dot, right? I mean, it's a small microcosm, if you like, of the Asian market. But I was just looking this morning, and you know, on the journal that you send out, Thai jet fuel, for example, Thai passenger numbers through the airports in August are at 367,000, the lowest since May 2020. Which says to me that demand is not improving on that side at all. I mean, that is for Thailand, and its dependence on tourism dollars for its GDP is, you know, that's a very damning situation. And then we look across at the larger nations, and you can never ignore China. And I always like to look at what China's doing in terms of crude imports and in terms of clean product exports. And crude imports are down. You know, across August. In September, Chinese crude imports are about 8.7 million barrels a day. They'll be slightly higher in October, probably just under 10. But this is from a country that 6 months ago was consistently importing over 10 million barrels a day. And if China's backing off, then that's a pretty poor sign for the rest of the region. And then again, as I say, you know, on the clean product side, we look at output, we look at exports of gasoline and diesel in particular, and again, they're down, way down on what we've seen in recent months, and in fact over the last 18 months. So these are all relatively bearish signals, I would say, for demand, but they will, I mean, effectively the CPP market will tighten up as a result of the falling exports. But it's difficult to get, difficult to get bullish about regional economics and regional demand when you're seeing this situation in a number of key economies across the region.
Well, let's go to China and get the word from the street, so to speak. Victor Yang, senior editor at JLC Network Technology. Victor, clearly China is giving out each week signals of, let's just say, less than rather than more than, right? I mean, it is on a sort of policy level, sort of trying to close things down. And we had the news yesterday that out of the Global Times, the big Chinese Communist Party newspaper, that power shortages were going to be a real factor this winter. How should we read China's economic performance and health and appetite for energy going into the fourth quarter?
Well, first of all, regarding power shortage, well, there are several major reasons. Well, first was the soaring coal prices. Well, and coal prices had more than doubled over the past year. Well, and as for power prices in China, it's government control. It's not allowed to go up. So power plants are suffering heavy losses at the moment. And source from a power plant in the Beijing-Tianjin area was quoted as saying that if this goes on for more than 1 month, well, local coal power plants would all collapse. Well, based on the current cost and the power prices. Well, and another reason is the shortage of coal, because China has, well, kind of restricted coal production, and it has also cut coal imports. Well, and these are the two reasons for shortage. And the other reason for the power rationing and even outage is the policy, because of the, we call it dual control. That's to reduce the energy intensity and to reduce the amount, or to keep, at least to keep the amount of energy consumption under control. And at a recent conference, well, the government, the country's, well, National Development Reform Commission criticized 9 provinces for increasing energy intensity in the first half of this year. And so this broadening power rationing came after this conference. And 10 other provinces as well were criticized too for lagging behind the targets for this power consumption cut. So basically, there are two reasons for the power rationing. The first one is power shortage, particularly this year when while exports had surged and power consumption had dropped by over two-digit growth as well. So it's quite different. And the other one is the policy. But some governments have announced, some local governments have announced that this power rationing will last until the end of this month or early next month. That's after the holiday for the National Day, say on August the 8th as well. So we expect the power rationing to ease in October at least, because the government is not,
It certainly seems to, on the general narrative, the market, it seems to be, Matt, pricing in this inconsistency of the Chinese outlook without being too disturbed by it, given that China is obviously the biggest oil importer in the world, Matt, and yet the market doesn't seem to be taking that on, more moving on the basis of a less than a negative number on API inventories. How do you read that, Matt, the inventory report yesterday? Do you think it'll be backed up by the EIA today? Why would that move the market so much?
I think it's a very good question, Sean, to be honest. I mean, what Victor was just saying about China is so important for the general fossil fuel rhetoric and for people to look at, but it's been largely dismissed. It's been largely dismissed. China has long been the savior of energy markets and has been something that people have looked at. Even when refinery runs are down and they release barrels from the SPR, that's still a good thing, as Mike Muller said when you were called the other week, because, well, that's good because they can replenish their stocks. So China is always what the market are looking at. China is key, and China is key for Q4 because the second half was the savior, and Q3 has been pretty poor. Q4 will be the savior, and people will look to China to give that a boost. Well, API data, EIA data, look, Sean, it's been largely dismissed, mate, to be honest. Like, Hurricane Ida was the most devastating hurricane for the US Gulf Coast oil system in history. And what it's done is it's provided a welcome distraction from a market. It's a difficult one. I feel like I'm arguing with myself, actually. I feel a little bit schizophrenic, to be honest, because you can be a bear for 18
Is there
years.
something? Is there an animal between a bull and a bear? Is there a new third way, as Tony Blair might say?
It's Yogi and his little mate. What's his little mate called, Kev? What was Yogi's little friend called?
Wombat.
Little friend, Boo Boo. So Boo Boo is sitting on my shoulder right here, and he's looking at it because 18 years I've been a bear, but I can form an argument now to be bullish, and I can agree with Omar. And I've met him a few times, and it's the first time I've ever agreed with him. I can agree with him that oil is going one way, and that is up. Supply is down, demand is up. The world is looking at Western Europe, and it's looking at the US. Does the market care, Sean, about API data or EIA? I don't think so. I think.
Well, let's ask Kevin. Does the market care that yesterday, I would say, perhaps for the first time, Jay Powell acknowledged that inflation could be a permanent issue, not a temporary one, which the Fed has been selling for the last year. The acknowledgement that actually this could bed in. Is that a significant shift for the markets, do you think?
Yeah, I mean, I know that Rustin has just made a point, which I think is very valid on the meeting chat, that inflation is not transitory, and I think we've reached a situation now in so many markets and so many commodities and in so many sectors, and that goes as far as consumer goods, etc., that supply chains are creaking under demand effectively for end user goods, etc., and that's all knocking into inflation, getting to fairly high numbers in the US and in the UK and various other places. So yeah, is that going to change anytime soon? I don't see it. I mean, sitting here in the UK, I see all of the problems. Gasoline supply chain, obviously one of them, but everything else too is very, very limited. Prices are always rising, and we've got this situation that really is perpetuating inflation. So yeah, it's not a transient sort of situation. I think it's here for a longer term.
How is it? Sorry, Sean. How is it on the ground there, Kev? In terms of petrol stations, is it Daily Mail sensationalism, or is it a real issue at forecourts?
My own experience, I've heard of friends that have been limited to £30, so about 22 or so litres. Other measurements are available. But myself personally, when I've tried to go in the evening to avoid the queues, the petrol stations have been closed. Cones out, no fuel available.
Really?
So I think what's happening is, obviously, as I say, I talked about it from other markets, but the supply chain is creaking. And what the owners and the franchisees, et cetera, of the petrol stations are trying to do is limit sales outside peak times so that they've got, or maybe they're running out each day, I don't know, but it's like they're trying to make sure they have gasoline available during the day for the majority of consumers. And when that runs out, it runs out. But this is not supply driven in the sense of availability of gasoline.
Spiked on the back of this.
Yeah, of course. But I mean, the UK continues to be a net exporter of gasoline. We've got more than we need. The issue here is all about, and I've said this in an interview I did with another news outlet the other day, that this is about a distribution disruption, not an actual supply issue. But
this is logistics. This is logistics.
But the fundamental problem is the consumer doesn't care what the cause is. They just want their gasoline.
Well, the consumer is going to be paying a lot of money for everything over the next few months.
Yeah.
Victor, is that the case in China? Is inflation, however it's caused, a problem? I mean, obviously, we're seeing the release in China of a SPR, both on metals as well as on liquids. It would appear in an attempt to suppress prices. Is inflation a challenge in China as well?
Well, it's not yet a challenge, I may say. Well, but the government is trying to mitigate such risk. Well, say releasing another batch of crude reserves perhaps in the near future, and some other commodities too. So it's taking measures to ensure that this wouldn't be a big problem at least. Well, because now we have this kind of worries about the real estate market. And so the kind of concerns, well, and if we cut exports because of power shortage, well, overseas prices, you say, particularly in the United States, well, the inflation might go up much higher when go up much stronger. Well, so that would be an issue too.
Well, that mightn't be so. That might be a good way of putting the squeeze on the rival in terms of limiting the export of Barbie dolls at Christmas. You'll have riots on. I mean, I remember many years ago, was it the Cabbage Patch doll? There was fights in the aisles, maybe for completely different reasons. But Victor, in the context of China's sort of strategy at the moment, from the point of view of you said previously that sacrificing growth in order for making structural policy change, is that still a kind of the guiding principle of 2021 for China?
Yes, so I believe so. Well, and take the power outage for an instance, and the central government didn't require the local government to cut or to ration power supply. It was the local government who did so. But the central government set targets for them to reduce, power consumption and energy intensity. Well, what about the local governments if they didn't accomplish the targets? Well, they took the domestic measures to ration power supply. So it's because just like they couldn't accomplish the targets well. So what did they do? They just went to some extreme measures. Well, so we can expect this kind to improve gradually, not so extreme, I mean, say in the rest of this year. But regarding the restructuring, it would be the government seems determined to continue to push forward with this one. And because it's crucial to accomplishing the targets for the emission neutrality. So this would be kind of, well, very strong determination, I would say.
Let's get the survey question in and see where the view in the room is regarding the fourth quarter. We saw obviously Brent pop above 80 yesterday, but the question is, what will Brent crude average in Q4? What will be the average price? What will be closest to 70, 75, 80, or 85? The reality is year to date, Brent has averaged closest to $70. Or has not, the average over the first 3 quarters is $70. But what will the average be in Q4 alone? Will it be 70, 75, 80, 85? Your choice, your view on that. What will be the average price of Brent in Q4? And so far in the first 3 quarters, it has averaged $70. Matt, how does OPEC Plus manage this moment? They do meet next week. All the expectation is a quick rollover. Any argument to be made that they should consider adjusting to cater for the fact that many of their members are unable to meet existing quotas?
Yeah, look, just first, I want to go to your survey question because I was trying to find the 65 answer. I couldn't see it there. Was it number
It
5?
just dropped off. It just, you know, it went with 80.60. So we decided
no, fair
we
enough.
wouldn't be that bearish. We wouldn't, our new boo-boo, we didn't want to be too bearish for our new boo-boo, right? That would
he
be.
does have a little friend.
You've set yourself up there now, Matt, right? This is just, you know.
I can't believe I've done that, Sean.
You know, that's it.
Look, it's an extraordinary, just on the survey question, joking aside, it's an extraordinary question to ask where we were this time last year. Even October, end of October last year, Brent was trading down at $36 a barrel. And here we are now with so much confidence in the market that we can put a floor on a survey question that says, is Q4 Brent going to be at minimum $70 a barrel? So look at the rhetoric of the market. It's an extraordinary move that we've had, you know, double price in the last 12 months. Look, what do OPEC do? I want to be polite here, Sean, and I've got to use all my tact. They need to produce more oil. They do. It's a very delicate situation. I don't know what the world is in a apparent energy crisis, and you have to read any newspaper, not just the Daily Mail, to see evidence that people in the streets of the UK are facing issues when it comes to petroleum. Is that because the world is running out of oil? It's not. The world is not running out of oil. The world is going through an energy market that is 2018 highs 3 years ago, based on the fact that there are still 4 or 5 million barrels of production on the sidelines. Morally, if you're OPEC and your agenda is to what? Is to support prices or to support the end user? Arguably, those two go hand in hand. If the end user is upset and there is a crisis going on, there is an argument that can be formed that 1 to 1.2 million barrels of production can be brought back and will be absorbed without causing a big shock to prices. So let's say next week when they meet on Monday, 400,000 barrels comes back as they agreed, but nothing more. We could spike to 90 in 2 days because there is not enough oil in Q4. And we're talking December loadings now, right? We're in the October trading cycle, we will be next week. So we're talking December deliveries. I personally think they need to double the amount of production they're going to bring back for the next month. You know, they need to say that to the market. Otherwise, we could be in real danger. And it's just going to cause massive spikes in the energy markets.
Kevin, there's been reports that UAE has committed to full loadings to Asian customers for next month. Your thoughts on that? I mean, we haven't seen in August the 400,000 increase. I think they only managed 100 or less even. As September looks to be the same. Is there a a space, a requirement, do you think, in order to calm the market, that OPEC Plus does add at least the 400 that they've committed to?
Yeah, and I think, there needs to be a sympathetic approach. I mean, Matt's point is right. You've got the fundamental sort of criteria, the fundamental priorities of, excuse me, of managing price and managing your consumer. And given that OPEC effectively has restricted supply over the last year and a half or so, and that really has driven this price rise that we've seen, then you have to expect that OPEC has some sort of sense of responsibility and says, yeah, we need to actually increase output the way that we said we would, at least, because otherwise effectively it's going to be seen as a reluctance to accept the realities of the market, and that's going to drive prices higher and ultimately hurt the consumer. And if it hurts the consumer, i.e. you or me, then it starts to push through to the major customers, i.e. the actual buyers of crude from Abu Dhabi and Saudi and so on. So I think the signals out of OPEC need to be pretty positive next week in terms of increasing production, because otherwise, as Matt said, we're going to get higher prices, and we're going to get people feeling very much disgruntled about the action of the group.
Well, you wonder in a way that the investment that needs to go into just maintaining current production levels hasn't happened within the OPEC Plus group. And are there more countries beyond Angola and Nigeria and within the agreement? Obviously, there's issues with Venezuela, Libya, Iran for all different reasons. But you wonder if there's more countries than we think that are unable to return supply, because the discipline has been incredibly impressive. If indeed it is just discipline and not just is operational limits. And I think we might be surprised that there's more countries who are operationally limited to add new supply. Victor, you get the last word this morning. Let's see what the survey result was. So the average price for the Brent crude oil in Q4 is a battle between 75 and 80. Clearly, in either case, Victor, they are high prices. How would China react to a sustained period at this level, 75 to 80? Would it impact demand? Would it reduce demand?
Well, first, China still had plenty of stocks. Stock of last year. And
when you
secondly,
say plenty, what is the number in days of cover? 90, 100?
Well, not that high, maybe about much lower than 100 days, I'm sure. But it's still releasing some to help cut the cost. But this has not made much impact on the market because the volumes that it has released is too small. So it's going to to continue releasing more from the reserves as well.
Is it so far only 20 million barrels have been released? Is that right?
Yes, no, less than 20 million because
less.
One of the auction, was not bid. Some barrels were not sold because of the price or some other reasons as well. And independents are shorter quotas too at the moment. So the market is kind of expecting the fourth batch of quotas on crude imports in the coming days. For independent refiners, that will be kind of key issue for independent refiners. If they get the issue, the quotas in the coming days, they would probably boost imports in the coming months. Otherwise, there would be kind of quite a significant job in the rest of the year. And so we also had to keep an eye on the power outage in the last quarter because, during winter heating, coal supply would be shorter and there would be less hydropower. Hydropower accounted for 9.1% last year, and that would be kind of severe in the last quarter of this year. So we had to look at these issues too. Yes.
Okay. Well, let's wrap it up there with the survey indicating $75 to $80 oil price for Brent in Q4. Brent, of course, today, at least so far in early trading in Asia, has corrected significantly down from the high we saw yesterday, and we'll have to see whether there is a recovery or not back above the 80 mark. But certainly this morning we're seeing Brent trade closer to 77.50 or 77.57 as we speak. Let's wrap it up and thank Matt as always for his insights. BB, Boo Boo, or Bearish, they all count. Kevin Wright from the Republic of Derby, and Victor Yang, staying in Asia, keeping the light switched on. Thank you for your insights this morning, and we'll catch up with everybody last day of the week tomorrow, at least the Middle East week, and see where the market is ending this week in which prices did at least temporarily tip above $80 on Brent. Thank you very much, guys.